Mortgage Dr. Rich here with a basic overview of the adjustable rate mortgage. Adjustable rate mortgages, also referred to as ARMs, are loans where the interest rate will fluctuate based on the terms of the mortgage after the loan has closed. There are two types of adjustable rate mortgages. There's the standard ARM and then there is the hybrid ARM. A standard ARM is described as a 1-1 ARM. All ARMs are described as two numbers separated by a forward slash. The first number always designates the initial period of interest rate stability. So although the loan is a 30-year loan, typically a 1-1 ARM means that the interest rate is stable for the first year and can fluctuate up or down after that for the remainder of the 30 years. Every year is the adjustment. A hybrid ARM has a longer initial period of stability, 2 years, 3 years, 5 years, 7 years, or 10 years. The main idea behind the ARM is the lower the initial period of the shorter the initial period of interest rate stability, the lower the start rate, so the borrower gets a lower payment, but the sooner it starts adjusting. And in a low to moderate interest rate environment, when there is a very high lender and investor appetite for ARMs, all ARM options are supposed to be priced, or typically will be priced, lower than the 30-year fixed. So when might an ARM product be good for the customer? Well, let's say the customer is only planning on being in the home for a short period of time, let's say 4 years. And if a 5-1 ARM is priced lower than a 30-year fixed, they're in the loan for 4 years, they sell the home, they get the benefit of the lower rate, and then once they sell the home in 4 years and pay off the mortgage, they don't have to worry about what rate fluctuations are going to be after that. Meanwhile, they got a rate that was lower than the 30-year fix they would otherwise have had. Whenever you're considering a borrower for an ARM, the borrower must be ready, willing, and able to accept the loan's worst case scenario. And as the mortgage loan originator, it's your job to make them aware of what that could be, even if that is more aggressive than what the maximum term for underwriting the loan would be. Every ARM customer must be thoroughly aware of the worst case scenario that could occur on that loan so that they're making an educated decision. ARMs are not as unpalatable, for lack of a better word, than you might think. It really could make a positive difference for a customer to pursue an adjustable rate mortgage if their needs and wants warrant it. So when it comes to ARMs, 4 components. There is the frequency of change, how the timing of the adjustments occur, the index, which is the component of the fully indexed accrual rate that causes rate fluctuation. Component number 3 is the margin, and that represents a fixed amount that's established at the time of origination. That represents the lender and the investor's profit and operating expense. And then come the caps, which represent consumer protection. If you want a far more detailed explanation of adjustable rate mortgages to make the light bulb go off and it click into place, visit www.nmlstraining.com, and in the training video section, I offer an ARM training video that goes into what I just kind of overviewed in much greater detail, and you'll end up understanding ARMs much more thoroughly than in this brief synopsis. Like, follow, share, do whatever you need to do in order to stay in touch with these videos so that you and be privy to the tips and strategies I profess to these, so you can knock the NMLS exam out of the park and launch your successful mortgage career. Mortgage Dr. Rich here saying goodbye for now. We'll see you soon.